Back to Trading Hour on CNBC TV18. Let's invite Rakshit Ranjan now, who is the portfolio manager at Marcellus Investment Managers, to discuss the market fundamentals and the outlook going forward. Rakshit, hi, good morning and welcome to the show. I don't know if you had a chance to listen in to my colleague Nimesh talking about the move in PSU Banks, and there's a Morgan Stanley note this morning as well about how the operating leverage for these banks could move up. There's sustained growth, but it has become a bit of a crowded trade now. So I wanted your sense here. Is there still an opportunity for a retail investor to get in from a long-term standpoint in some of these smaller PSU banks? I'm not talking about the SBIs of the world, but in the broader markets.
Yeah, good morning. So for the PSU banks, there have been two types of trades. One was the recovery after the COVID-related increase in credit costs. That recovery played out till, say, 6 months ago. The second is what happened in the last couple of months, which is where incremental loans issued in the retail segment have had lower credit costs in an environment which is facing massive tailwinds around credit growth for the overall industry. Right now, that's the reason why this trade is playing out the way it is. But when you look at, let's say, the leverage of many of these banks, so leave aside an SBI, which is more than 20 times leverage, but most of the PSU banks are 15, 17 times leverage with ROAs, returns on assets of less than 1%. The margin of error there is very small, very thin from a long-term standpoint, right? So as long as the short-term trade continues, where credit costs are low on newly issued retail loans, the trade will play out. But from a long-term standpoint, with less than 100 basis points of returns on assets and heavy leverage, I think it's far better to instead go for lenders with 2.5–3% ROAs with leverage which is 5 or 6 times, and hence on the larger side, the likes of, say, an HDFC Bank or a Kotak make a lot more sense for long-term investment perspective. And even on the smaller side, there are several NBFCs which I would suggest would be better sort of trades from a long-term perspective compared to PSU banks.
Rakshit, on the same point, I know Marcellus has generally shied away from PSU banks, and you all have said that you've seen multiple cycles of boom and bust when it comes to PSU banks. But is there a case to be made that maybe this time it could be different? Yes, right now the return ratios are much lower, sub 1 versus so many of the private sector financials which can give you a much better return ratio. But we are seeing an improved balance sheet, a broad-based pickup in loan. Do you not think this time maybe it could be different for PSU banks and they could be long-term wealth creators, not just the cyclical pop that we are currently seeing?
Yeah, good question. Look, that would happen. I mean, you would switch this observation from a short-term oriented tailwind to a long-term one for the PSU banks, provided the practices of lending at the ground level have radically changed. If you see such changes, if you see the change in the way they would collect from loans given, if the change in the way they would decide on credit profile of their borrowers, if those practices are changing, then certainly yes. But we've actually not seen any significant change worth talking about in the way PSU banks would be lending and collecting their loans now versus, say, a year or two ago. These cycles are, in some ways, I mean, this is cyclical, right? That's why we're calling it a cycle. Think about it like this: 6 months back, the commodity producers underwent a massive upcycle, right? That lasted only for as long as the tailwinds lasted. This is no different the way we see it.
All right, that is something that we pick up. Rakshit, thanks for joining us. The other question I wanted to ask you about is, you have mentioned the entire China plus one factor sort of aiding India. What are the sectors that you see will be perhaps most benefited by this? Do is it the usual chemical names, pharma names that you see getting the biggest impact from this?
Yeah, I think no doubt about it. Chemical and pharma are the biggest beneficiaries. So if I were to again break this tailwind down into two parts, the first piece was the pollution control that China had implemented from 2015-16 onwards, which led to a lot of tailwind for Indian chemical and pharma industry. But what has happened in the last 12 months or so is there are lots of big pharma companies which have categorically told their manufacturers that nowhere in the entire value chain, whether it be raw material procurement or their own manufacturing, nowhere in the value chain they want to see the relevance of China being high, the dependence on China being high. I won't say the entire big pharma industry has shifted their orders in this way, but we see incrementally a lot of tangible shift in that regard, and hence the tailwind would be to chemicals and pharma first before other manufacturing industries start experiencing this tailwind.
Okay, I wanted your thoughts also on autos, because this has been quite a strong month for SUVs, for commercial vehicles. Barring two-wheelers, I think all other sectors have picked up in a big way. Any preferences here?
Yeah, in fact, I would actually say when you compare the pricing power to benefit from a tailwind and hence the margins and returns on capital, some of the two-wheeler companies like, say, an Eicher Motors, which we have in many of our portfolios, Eicher Motors is a far better pricing power play compared to many four-wheeler OEMs. Right, there are very few auto OEMs. We have one or two in our portfolios, where there are very few auto ancillary suppliers who would have pricing power against the larger OEMs either. So yes, there's a cyclicality here as well, but ability to sort of retain the tailwind as profits and returns on capital is the challenge. Otherwise, we would have liked to own four-wheelers as well, but prefer two-wheelers.
And in that, Eicher Motors. Rakshit, Berger Paints and Asian Paints are two stocks in the paint industry which you've bet on. And here I'm quoting a recent report from Nuvama, where they're saying that Akzo Nobel and Kansai are playing catch-up with leaders in aggression. In new projects, Akzo and Kansai are getting more aggressive. Akzo doing better than earlier on a case-to-case basis in B2B deals. Overall, the weighted watch period in terms of product launches vis-a-vis Asian Paints is shortening. Do you think there is a risk that these companies, smaller in size right now, but could challenge the authority of Asian Paints and then even Berger Paints?
Right.
Is this something that you've observed?
No, we haven't observed on the B2C side any changes in the ground level dynamics. So when you look at the revenue growth of decorative paints, right? And this is where it's interesting when you frame the question, there was B2B mentioned in it. And Kansai and Nerolac might be benefiting from auto upcycle in some way, but because half of their business is B2B. But when it comes to the decorative business, right, which is where the entire profitability and ROC for even a Kansai and an Akzo lies, that's where the last 3 years CAGR of volumes for Berger and Asian have been around 18 to 20%. For Nerolac and Akzo, it has been around 11 to 13%. So there's a good 5 to 7 percentage point gap, whether you look at last quarter's year on year or whether you look at last quarter's 3 year CAGR. There's no short term or long term trend which would support this hypothesis. Having said that, we've seen several such attempts by many competitors to sort of become better. Some of them might become better than their previous avatars, but we don't see any moderation in market share gains by Asian Paints, by Berger in the broader paint industry. On the contrary, though, we do see massive capital allocation decisions by Asian and Berger in the direction towards disrupting the whole paints industry in the long-term future and raising barriers to entry against any new incumbents, whether they be cement players or other paint companies. That's actually far more encouraging. That's the development that we have observed, not the other way around.
Okay. All right, Rakshit, we'll leave it at that. Thanks a lot for joining in and talking about the markets and several sectors. Let's slip into a short break. But when we come back, we'll get you more on the markets and we'll get you some important views as well. So stay tuned in.